Risk management in investments. Protecting your portfolio in volatile markets. Did you know that in times of market volatility, investors can lose up to 50% of their portfolio value if they aren't careful? The financial markets can be unpredictable, and one of the biggest challenges investors face is managing risk effectively. Whether you're a seasoned investor or just getting started, understanding how to protect your portfolio in volatile markets is crucial for long-term financial success. In this video, we're going to dive deep into risk management strategies and show you exactly how to safeguard your investments during turbulent times. By the end of this video, you'll be equipped with the tools and knowledge to weather market storms and keep your portfolio intact, even when the markets get rocky. So, stick with us until the end to learn how to manage risk effectively, build a resilient portfolio, and ensure that your investments can withstand market fluctuations. Let's get started. 1. Understanding market volatility. First, let's define market volatility. In simple terms, volatility refers to how much and how quickly the value of an asset or market can change. Markets experience periods of volatility when prices move up and down rapidly, often without clear trends. This can be caused by various factors, such as economic changes, political events, or even global crises like pandemics or natural disasters. For investors, market volatility can feel unsettling, especially when stock prices fall sharply. However, volatility is a normal part of investing, and the key is learning how to manage it rather than trying to avoid it completely. 2. Risk and return. The balance you need to understand. The relationship between risk and return is fundamental to investing. In general, the higher the potential return of an investment, the higher the risk. Conversely, safer investments tend to offer lower returns. The goal of risk management is to strike a balance between the two, seeking enough growth potential to meet your financial goals without exposing yourself to unnecessary risk. It's important to remember that all investments carry some level of risk. Even seemingly safe investments like government bonds can be affected by inflation, interest rates, and other economic factors. Therefore, risk management is about controlling how much risk you're willing to take and reducing the impact of market volatility on your portfolio. 3. Diversification. Spreading your risk across multiple assets. One of the most effective ways to manage risk is diversification. Diversification is the practice of spreading your investments across different asset classes, industries, and geographical regions. The idea is that by holding a variety of investments, you reduce the likelihood of significant losses, because not all assets react the same way to market conditions. For example, during a stock market downturn, bonds or other fixed income assets may perform better, helping to offset the losses in your equity positions. Similarly, investing in international stocks or assets in other countries can protect you if the economy in your home country experiences a recession. Types of diversification to consider. 1. Asset class diversification. Invest in a mix of stocks, bonds, real estate, commodities, and other assets. 1. Different asset classes often perform differently in various market conditions. 2. Sector diversification. Within stocks, diversify across different sectors of the economy, such as technology, healthcare, finance, consumer goods, and energy. 2. If one sector is struggling, others may be thriving. 3. Geographical diversification. Invest in both domestic and international assets. 3. Different regions may be affected by different economic or geopolitical events, reducing the overall risk to your portfolio. 4. Asset allocation. Setting the right mix for your goals. Asset allocation refers to how you divide your investments across different asset classes, such as stocks, bonds, and cash. The right allocation depends on several factors, including your investment goals, risk tolerance, and time horizon. 1. Time horizon. If you're young and have many years until retirement, you may be able to take on more risk, allocating a higher percentage of your portfolio to stocks. 1. If you're closer to retirement, you might prefer a more conservative approach, focusing on bonds and other safer assets. 2. Risk tolerance. Your personal risk tolerance plays a big role in determining your asset allocation. 2. If you're comfortable with market fluctuations and can handle short-term losses for long-term growth, you may choose a more aggressive allocation. 2. However, if you prefer stability and want to avoid significant losses, a more conservative approach is better. 3. Investment goals. The purpose of your investments also matters. 3. Are you saving for retirement in 30 years or looking to preserve capital for the next few years? 3. Your goals will determine whether you focus on long-term growth or short-term stability. A common guideline is the 100-age rule, which suggests subtracting your age from 100 to determine the percentage of your portfolio that should be in stocks. For example, if you're 30 years old, 70% of your portfolio could be allocated to stocks and 30% to bonds or safer investments. As you approach retirement age, you might gradually shift towards more conservative investments. 5. Hedging. Using strategies to offset potential losses. Hedging is another important tool in risk management. It involves using investment strategies to offset potential losses in other areas of your portfolio. This doesn't eliminate risk completely, but it can help reduce the impact of unfavorable market conditions. Some common hedging strategies include: 1. Options and futures contracts. These financial instruments allow you to bet on the future price movement of an asset, such as stocks, bonds, or commodities. 1. For example, you might buy a put option, which gives you the right to sell a stock at a set price in the future, thereby limiting potential losses if the stock price falls. 2. Inverse ETFs. An inverse exchange-traded fund, ETF, is designed to perform the opposite of the market or a specific index. 2. If the market falls, an inverse ETF rises, providing protection against downturns. 3. Commodities. Investing in commodities like gold or silver can act as a hedge during market downturns, as these assets often move in the opposite direction of stocks. It's important to note that hedging strategies can be complex and may not be suitable for all investors. Beginners should educate themselves and consider consulting with a financial advisor before using these techniques. 6. Rebalancing your portfolio. Keeping your risk in check. Over time, the value of different investments in your portfolio will change. As some assets grow and others shrink, your original asset allocation may no longer align with your goals and risk tolerance. That's where rebalancing comes in. Rebalancing involves periodically adjusting your portfolio to bring it back to your desired allocation. For example, if stocks have performed well and now make up a larger portion of your portfolio than you intended, you might sell some stocks and buy more bonds to restore the balance. Rebalancing is important because it helps you manage risk by maintaining your target allocation. Without it, you may inadvertently end up with too much exposure to riskier assets, increasing the chances of a larger loss in the event of a market downturn. Conclusion: protecting your portfolio in volatile markets. Managing risk is one of the most important aspects of successful investing. By diversifying your portfolio, setting the right asset allocation, and using strategies like hedging and rebalancing, you can protect yourself from the worst effects of market volatility. Stay patient, stick to your long-term strategy, and remember that markets naturally go through ups and downs. If you found this video useful, don't forget to give it a thumbs up, share it with your friends, and subscribe to our channel for more insightful tips on managing your investments.